We're going to look at a sample problem for the statement of cash flows. What we're going to do in this example is the indirect method. Now, this is going to involve an account reconciliation. What reconciling means is getting from one number to another, okay, and determining what the differences are between the two. So what we're going to do is we're going to reconcile from our net income number to a net cash number, which will show us what our cash flow was for the period. Okay. Now, first we're going to look, the cash flow has three sections. It has an operating section, an investing section, and a financing section. You're going to need to print the sample, the supplemental example information that I've provided for you on Blackboard. You should have two tabs there, an income statement and a balance sheet. And we'll be referring to those two things throughout the problem. We start with a heading, our who, our what, and our when. This is a cash flow statement, so it measures a period of time. So it's going to say for the year ended or year ended is fine. Okay, the first heading here is going to say cash flows from operating activities. And we're going to start, this is where we're going to start the reconciliation process. We're going to reconcile from net income, so that's the first thing that's going to appear. This comes straight off of our income statement that was provided to you. So $83,200 is the net income number. Now, we have a lot of things in that net income number that did not involve cash. So what we're going to do is we're going to back those things out. So any depreciation, depletion, or amortization that you see on your income statement, you're going to take that out. Now, it tells us in our supplemental information that our operating expenses included depreciation expense on buildings of $6,000, $11,550 on equipment, and amortization was $24,000. So those did not involve cash, okay, but they're in our net income number. So we want to take those out. So we're going to back those things out of that net income number so we can get to our net cash number. So here they are. Depreciation expense, $6,000 for buildings. Equipment was $11,500. It should say $11,550. And then we have amortization expense for intangibles, $2,400. So all those were subtracted to get to this $83,200, but we want to back them out, so we're going to add them back in. Okay, so we're going to do the reverse of what we did to get to the net income number. That's what I mean by backing them out. Okay. Next, it says gain on sale of investment. Now we look at our supplemental information number 2. It says we sold long-term investment that cost $35,000 for a gain of $6,250. Now this gain of $6,250 is in our net income number, and when we recorded that gain, we added it to get to net income. Okay, we added the $6,250 gain. Now we're going to subtract it because we're going to include the entire amount, what we want to appear on the cash flow statement. This is going to appear later in the investing section. We want the entire amount that we got for cash to appear by itself, so we don't want this number counted twice. Okay, so that's why we're backing it out. So it was added to get to the $83,200. Now we're going to subtract it to get to our net cash number. Same thing goes for loss. You do the opposite of what happened before. So this loss on disposal of equipment was $1,150. Okay, this is from number 5 on your supplemental information. So that loss also is going to have to be backed out. So we do the reverse. Okay, so a loss was subtracted in our net income number of $83,200. So we're going to back it out by adding it back in. So that reverses what we did in the net income number. And again, it's going to appear the entire amount of cash that we received for selling that equipment is going to appear, but we don't want it counted twice because it's already in the net income number. Okay, that's why we're backing it out. Okay, the next thing is it says we're going to add to that, and we're going to take care of any changes in current assets and liabilities. So there's two ways of looking at this. Okay, one is your changes in current assets works in the opposite direction as cash flow. So there's an inverse relationship. So if you want to memorize it, that's your memorization. So if accounts receivable or any other current asset decreases, then cash will increase, and vice versa. If a current asset increases, that means cash will decrease. So as we see, it's working just exactly the way we expected it to. And these numbers are coming off of your comparative balance sheet. If you look at the comparative balance sheet that you printed in your supplemental information, you'd see a comparison between 2014 and 2015. And it says that accounts receivable decreased by $9,250. And they work in the opposite direction. So accounts receivable went down, cash goes up. Okay, so that'd be cash inflow. Another way of looking at these is just reasoning them out. So if you think about if accounts receivable is decreasing, so the amount of money someone owes me went down, the only way it went down is if someone paid their bill off. Someone that owes me money paid it off to me, okay? So they paid you money. So that's a cash inflow. Now if inventory increases, that means you bought more inventory, so cash is going out. So that's an outflow of $10,500. Prepaid expenses works the same way. If that was say a prepaid insurance account, that means you bought more insurance, so cash is going to decrease. Now, current liabilities work in the same direction. So you decrease a current liability, you decrease cash. You increase a current liability, you increase cash. So that's why those are working that way. Now, if you want to understand it, if you decrease accounts payable, the only way that accounts payable decreases is when you pay your bills. So you have paid cash out, so that's a cash outflow of $50,000 for accounts payable. Now, accrued liabilities and income taxes payable work the same. Okay, if they're increasing, that means you did not pay out any cash. So definitely not a cash outflow, because what you did was you held on to your cash. So that's considered a cash inflow for the statement of cash flows. So that's an increase of $2,500 and $10,000. Okay, now this $24,900 is the net effect of all of these things right here, these reconciling items. Now if you take this and you subtract it from your net income number, then you'll have your cash flows from operating activities of $58,300. Next, the next section is your cash flows from investing activities. Things you should see here are words like investment or plant, property, and equipment type things. So land, building, machinery, fixed asset sorts of things, okay? So the first thing we see is, and this was also in number 2 of your supplemental information. Remember I told you later on in the cash flow statement we're going to want the total sum of cash we received for that activity? Well, this is it right here. So number 2 says we sold long-term investments that cost $35,000 for a gain of $62.50. Now we want to know what's the total cash we received, because it's going to go right here in this section. So we didn't receive $35,000, we received $35,000 plus a gain of $62.50. So we add those two together and we get $41,250, and since it was a sale, someone paid us money, so it's going to be a cash inflow. Okay? Next, on number 3, it says we made other long-term investments in the amount of $10,000. So that's us investing our money, so we're paying it to someone else. So that's a cash outflow. That was number 3 on other information. Next, you'll see purchase of land for $12,500. Super easy. We bought something, so that means cash is going out. So it's an outflow of $12,500. Next, it says we sold equipment for $49.50. Okay, now what we want to know, first we have to compare book value, and then we have to look and see if someone paid us more than book value or they paid us less than book value, because that's where the gain or loss comes in. And it said that we sold equipment that cost $18,750 that had accumulated depreciation of $12,650. This is number 5 in your other information. So that means our book value was $6,100. But it didn't say anyone paid us book value. It said we sold it for a loss of $11.50. So we sold it for $6,100 less the loss of $11.50. So that's where $49.50 comes from. And that's an inflow because we sold equipment. Okay, the next piece, number 6, says we purchased equipment for $15,000. That one's very easy. We bought equipment, cash outflow of $15,000. So the net effect of all of our investing activities is $87,000 inflow. Okay, financing activities is our last section. Now what it is we talked about there are 2 types of financing. If we want to raise money for our corporation to expand or do a new product line or whatever we're wanting our money in our hands for, there's 2 types of financing. There's debt and there's equity. Okay, debt's going to cover your mortgages, your long-term notes, your any kind of long-term debt that you have. Financing activities are going to be those things that we studied that were stocks. Okay, so common stock, preferred stock, buying back treasury stock, paying out dividends, any kind of financing activity, equity financing activity will appear here too. Okay, so the first thing we see, it says that we repaid a note payable in the amount of $50,000. That's number 7 on our supplemental information, so that's a cash outflow because we're paying off our bill. Now, this issuance of a notes payable, this one's a little bit tricky. We have to look at a couple of different things here. What we do is we look at our comparative balance sheet under notes payable, okay? And it says that we had a $35,000 decrease overall in notes payable. Well, that's interesting because we just said we repaid our note for $50,000, but it only went down 35. Well, that means what? It means we issued a new note. So we got more money from the bank, a different loan. Okay? So that will be a cash inflow of $15,000. Next, it says we reduced the mortgage. Okay? You could also determine that $15,000 from number 8. It says we borrowed $15,000 by signing a new note payable. Okay, now number 10 says we reduced the mortgage payable account by $10,000. If we reduced what we owe somebody, that means we paid our bill. So that's a cash outflow of $10,000. 11 says we declared and paid cash dividends of $25,000. Okay, definitely an outflow because we're paying our dividends to our shareholders. And then it says we purchased treasury stock on number 12 for $5,000. So there's our outflow of $5,000. The net effect of all of these transactions is an outflow. Net cash from financing activities is a $75,000 outflow. Okay, next is the reconciliation of cash piece. Now, if we took this $75,000 from financing and we went up and took the amount from our investing activities above and then our operating activities, all three of those would net together a cash outflow of $8,000, okay? So if you take the net effect of that net decrease in cash, you should be able to look at your comparative balance sheet, and your cash compared from 2014 to 2015 should say an $8,000 decrease, and it does. So then you just put your cash at the beginning of the year, take the difference of the $8,000, that puts you at $52,950. That should be the cash at the end of the year, and we look on our balance sheet, and that's exactly what it says. $52,925 was your ending balance in 2015. The only thing you need to add are any non-cash investing and financing transactions. And what this means is things that would normally appear on the investing and financing section, but you didn't really involve cash, you just traded one for another. So in this section we had some information on number 9 in the other information that says we converted $50,000 of bonds payable into 3,000 shares of common stock. So there was no cash involved here, it was just a trade between the two. So it's going to be shown here in a little supplementary section. And that's it. Here's your statement of cash flows all together. And that's all we have to do.